Hello students. So we would be starting today the Accounting Standard 2, which is on valuation of inventories. And in this particular accounting standard, firstly we will be taking a look as to what is the objective of this particular accounting standard, what are inventories and how such inventories are valued in the books of accounts, what are the steps for such valuation of inventories, how cost of inventory is calculated, what is the formula for such calculation, and what are the disclosures that are required to be made in the financial statements once the inventories are valued and accounted for in the books of accounts. So starting with the accounting standard and firstly looking at the objective of such particular financial accounting standard. So the objective of this standard is to formulate the method of computation of cost of inventories or stock for that matter. So when we are valuing inventories, so inventories are the stock of that particular company. So once the goods are purchased at a particular date, and the challenging part is that, for instance, you have purchased goods worth rupees 50,000, and out of those goods you have sold such goods, sold goods worth rupees 40,000. That means 20% is still left with you. You stole the 80%. So now how do you value such 20% of the stock while closing the books of accounts? So what is the value of the closing stock? And at what value or at what cost should it be recorded in the books of accounts? Again, so all of this is established from the valuation of inventories accounting standard. Again, if there are some goods that are produced in-house, right? So raw material has been procured and the other materials which are required in producing that particular finished good have been procured. However, there are certain goods that are still to be processed at the end of the accounting period, and some goods have been accounted or some goods have been produced, however they are not sold. So how do we value or how do we bifurcate between the valuation of such inventories as to certain which are in the certain goods which are in the processing stage and certain goods that are at the completion stage? How do we value such inventory in the books of accounts? All of that is established from the accounting standard 2, which is on valuation of inventories. So thus the particular objective of this standard is to formulate the method of computation of the cost of inventories, be it the closing stock, be it the goods in the processing stage, be it the goods that are not in the processing stage, or the complete goods or the finished goods that are there. So this is what is the objective of the accounting standard 2. And thus to determine the value of closing stock or inventory at which the inventory is to be shown. So what should be the value that should be shown in the balance sheet till the date of its sale and recognition as revenue? So once this particular, so like I said that out of the 50,000 goods, so goods worth rupees 50,000 have been procured. Goods worth rupees 50,000 have been purchased and rupees 40,000 as further sold have been for rupees 40,000 worth goods have been sold. Goods sold. So let's say that this was sold at rupees 70,000. So this sale value will be recorded in the books of accounts, right? This is the sale value. The cost would be 40,000. That would be recorded, and the remaining 10,000. Whether we should be declaring such closing stock at the cost value, or whether we should be declaring it or recording it at its realizable value, this is what we will have to ascertain on the basis of accounting standard 2, that is on valuation, and how valuation of this particular stock is to be done and shown in the balance sheet until such goods are further sold by the company. Till that date, we would be valuing such goods on the basis of AS2 and thus show them in the balance sheet. And further, this particular standard, however, is not applicable. So this also you have to pay attention. So in the objective section of the paper, questions can be asked on accounting standard 2, and of course question from particularly this segment can be asked as to accounting standard 2 is not applicable. So for instance, accounting standard is not applicable on the work in progress arising under construction. So all the construction, in the case of the construction contracts, if there is a work in progress material that is there, the inventory need not be valued according to AS2 valuation of inventories. Here the accounting standard that will apply in this particular case would be the AS7 construction contract. So you have to pay attention, and you have to, while solving that the objective type questions, a trick question can be asked, wherein the question can be formulated making the student understand or assume that the question is being asked on AS2. However, by including the work in progress related to the construction contract, they can test your skill whether the student is able to identify that here AS2 will be applicable or not. So such kind of questions can be asked while they are asking a question from in a multiple choice questions, for instance, or it could be fill in the blank question or matching, or it could be anywhere. They can apply these tricks in order to see that whether the student has completely gone through the AS2 accounting standard, or they have just looked it upon and just kind of completed it and not paid full attention to. So this is where the the application of your concept plays an important role, that you need to understand word by word a particular accounting standard, and which is what will ensure that you do not commit a mistake while solving either a conceptual question or a practical or a theory question. So again, so basically AS2 is not applicable in the cases of construction contracts, because as there would be AS7 which will be applicable. So here in the case of construction contract, AS7 will be applicable and AS2 won't be applicable. Again, work in progress arising in ordinary course of business for service providers, that is incomplete consultancy services or incomplete merchant bank activities or medical services in progress. So in such service cases, the valuation of inventories will not be done according to AS2, as here we are referring to the service providers, and here we are not referring to the goods that have been purchased or that have been manufactured, and the remaining stock of those purchased goods or manufactured goods is remaining in the at the end of the particular accounting period and is needed to be valued. In the case of service providers, such inventories or such services will not be valued according to AS2. So this is again an exception, that work in progress arising in the business or in the ordinary course of business for service providers will not be accounted as such work in progress will not be valued according to accounting standard 2. Then again, financial statement held as stock in trade, here also AS 30, 31 and 32 will be applicable, and such financial instruments that are even held as stock in trade will not be accounted according to the AS2 but according to AS 30, 31 and 32, which are based on the valuation of financial instruments in the books of accounts. Again, here producers' inventories like livestock, agriculture and forest products, mineral oils, ores and gases, such inventories are clear-cut valued at net realizable value. So there is here it should be, so when you are valuing such inventories or such producer inventories like livestock, agriculture, any forest products or any mineral oils, ores and gases, you have to keep in mind that such inventories would be valued in the books of accounts at their net realizable value. right? So these are the exceptions, and these are the points in which accounting standard 2 will not be applicable. So these cases or these exceptional cases has to be kept in mind, and you have to make sure that while you are solving a particular question related to valuation of inventories, the concepts of accounting standard 2 valuation of inventories will not be applicable in these 4 cases. And what all does inventory include? So goods, that is the finished goods which are held for sale in the ordinary course of business, would be regarded as inventory or stock for that matter. Then in the process of production of such sales, so goods which are in the processing stage or in the process of production of the final goods, that is being the raw material or the work in progress goods which have been procured by the business in a particular accounting period. However, they are still in the conversion stage and not completely manufactured as a final product by the business. Such goods will also be it a raw material or be it a work in progress, they will also be included in the inventories. Then in the form of materials or supplies to be consumed in production process or in the rendering of services, be it stores, spares, any raw material or consumables, would be a part of the inventories. And inventories, however, will not include any machinery that have been procured, be it that the machinery has been procured in order to convert the raw material into a finished good or a processed good into a finished good. Even in that case also, no machinery would be considered as an inventory in the case of any particular business. Further, inventories will consist of goods that are purchased and held for resale. So not only the goods that have been manufactured, but also if certain goods are procured by a particular business and are then further held for resale, such goods can also be a part of the inventory, as in the ordinary course of business, revenue would be earned by reselling such goods that have been purchased by the business. And inventories also consists of finished goods that are produced by a particular business, and then further work in progress which is produced by the enterprise would also be included in the inventories for that business. And also the materials or the maintenance or any supplies or consumables that have been kept by the business or have been procured by the business in order to manufacture or complete that particular those particular finished goods of the business. All such materials, maintenance, supplies, consumables would be also comprised in the inventories and accordingly valued as per accounting standard 2. Loose tools that have been held for use in the product. So all such materials which are held for the use in the production process in order to manufacture a particular final good, which will be thus held for resale or which would be further sold by the business in order to generate revenue, would be included as inventories in the books of accounts and thus valued according to accounting standard 2. And so further, inventories, however, will not include spare parts, any servicing equipment or standby equipment which meet the definition of property, plant and equipment as per AS 10, and thus that such spare parts or servicing or standby equipment will thus be accounted as a property, plant and equipment as stated in the accounting standard 10, which is based on the property, plant and equipment, and such spare parts would be considered as the assets of the business instead of including them in the inventories and valuing them. So the accounting treatment will differ completely. So therefore this particular point is an important point while you are making valuation of inventory, and thus you have to make sure that you do not include the asset valuation and thus value such asset according to and consider them as inventories, because this will completely change the outlook of the financial statement. So thus Such spare parts or servicing equipment and standby equipment should never be considered as an inventory. They should be treated as or should be categorized under the definition of property, plant and equipment as per accounting standard 10. So this particular point is an important point that you should be taking care of. Further, machinery spares, which is not specific to a particular item of fixed asset and which can be further used generally for various items of fixed assets, should be treated as inventories for the purpose of AS2. So as we all know, the assets, so what is the definition or what is the criteria of defining a particular asset? That asset is being used in the business in order to manufacture the final product which will further be sold by the business in order to generate revenue. And in this particular case, what happens is that machinery spares which are not specific to a particular item, that does not belong to a particular item, that item could be a particular inventory or a particular machinery or particular asset of the business. So in case such spares do not belong to a specific item of fixed asset, and thus it can be, and if that particular spares or machinery spares can be used generally for the various items of fixed asset, then such asset or then such machinery spares should be treated as inventory instead of treating it as an asset. So you understanding this particular point says that if a machinery spare is specifically used for a fixed asset, then it would be treated as per AS 10 as it belongs to a particular asset. So the cost of such machinery spare will be included in that particular fixed asset, and that particular fixed asset would thus be treated as per AS 10, which is based on the definition of property, plant and equipment, and will thus be treated as a fixed asset only, or a component of the fixed asset, thus treated as per AS 10. However, if that particular machinery spare does not belong to a particular item and can be used generally, for various items of the fixed asset, so it becomes generic. So we cannot include the cost of such machinery spares in all the assets, or we cannot kind of segregate into all the assets and thus include a part of the cost of those machinery spares in all the fixed assets. So thus what happens in that case is, since it cannot be used specifically or dedicated or composed in the cost of a particular fixed item, then such machinery spare which is used generally for various items of the fixed assets, such machinery spare will be treated as inventories for the purpose of AS2, and thus those machinery spares, so this is an exception to the above point. And therefore you should be, again, this is an important point, and you should not get confused that because we have studied about spare parts and servicing equipment or standby equipment, we should be valued according to the AS10 and should be included in the fixed asset of the balance sheet or of the business. So therefore machinery spares will also be included in the fixed assets of the company. So it is kind of correct to a certain extent that if such machinery spares are used for a particular component of the fixed asset or for a particular fixed asset of the business, so in that case machinery spares would be accounted or treated as per AS10. However, in case the machinery spares are used generally and cannot be specifically included in a particular item of a fixed asset, in that case what happens is that such machinery spares would be treated as inventories and valued according to the accounting standard 2. So hope this is clear, that this is how you will be differentiating between the machinery spares and other spare parts or servicing or standby equipment. So thus, what happens in the case 2, that such machinery spares will be charged to the statement of profit and loss as and when issued for consumption in the ordinary course of operations. Again, an important point, that if you value such inventories for the purpose of AS2, such machinery spares would be charged to the statement of profit and loss as and when it is issued for the consumption in the ordinary course of operations. So now, how should we be valuing? So up till now, what we have covered is what is inventory, what all is included, in inventories. AS2, where it is not applicable. So this is also we have covered inventories, or what all is included. Then AS2, where it is not applicable, and also what we were just referring was that spare parts, how we have to treat spare parts, servicing equipment and standing equipment as a fixed asset, and in the case of machinery spare, how we have to treat such machinery spares, or when we have to treat such machinery spares as inventories. So coming to how the inventory valuation is done in the books of accounts of a particular business. So inventories, according to Accounting Standard 2, inventories should be valued at lower of cost and net realizable value. So how do we ensure, or what are the steps that are required in case of valuation of inventory? Firstly, we will be determining the cost of those inventories that are to be stated in the books of accounts. Secondly, we will then be determining the net realizable value. And so after determining the cost of such inventories, we would come across and we would identify the net realizable value of those inventories after comparison. So once we have derived both the values, as in the cost of the inventories and then the net realizable value of such inventories, we will be comparing, or comparison between the cost and the net realizable value would be there. The comparison should be made item by item or by group of items. So that is again one big decision, that how we should be valuing the inventories that are to be recorded in the books of accounts. So whether we should take the cost and net realizable value on comprehensively, that by totaling the inventories and totaling the cost of the inventories and totaling the net realizable, or we should be going item by item. So that is again something which needs to be determined and accordingly followed in the books of accounts whenever you are valuing the inventories. So it should be item by item. Now, what all should be the costs that should be included while you are determining the cost of a particular inventory? First being the cost of purchase. Then if there are any cost for conversions, other costs that are incurred directly in bringing the inventories to their present location and condition. So these are the three components of the cost which would be identified, or which should be included while you are valuing the cost of inventory. Then further, cost of purchase shall include the purchase price, duties and taxes. Freight inward should be a part of the cost of purchase. Other expenditures that are directly attributable towards the acquisition of a particular inventory. And what should be subtracted from those purchase cost is the duties and taxes that is to be recoverable, that is recoverable by enterprises from the taxing authorities. Any trade discounts, rebates, duty drawback and other similar items shall also be excluded from the cost of purchase of those inventories. So this is the formula that you need to cost ascertainment. Formula that you need to learn and keep in mind, because a question can be asked in which you can be in which the question can be that these are the costs of a purchase of a particular inventory, and you have to, keeping in mind what should be added and what should be subtracted, you have to evaluate such cost of purchases of those inventories. And what is the cost of conversion? So it consists of the costs that are directly related to the units plus the systematic allocation of fixed and variable production overheads, as well as which are incurred in converting material into finished goods. So such systematic allocation of fixed and variable production overheads should also become the part of the part of those inventories, and this is how we will be valuing or ascertaining the cost of conversion. So what you have to include in the case of cost of conversion is that what are the direct costs or costs that are directly related to the units that have been produced. Then systematic allocation of any fixed or variable overheads if there are any. So such allocation of fixed and variable production overheads should be done, and that are incurred. So, and what are these allocation or what are these fixed and variable production overheads which have been incurred while converting material into the finished goods. So this is what cost of conversion comprises of. So all the units that have been procured and such units being converted from material into the finished goods, while doing those that particular process, if there are any fixed and variable production overheads that have been incurred by the business, systematic allocation of such overheads will be done and thus included in the cost of conversion of that particular inventory. Further, fixed production overhead means indirect cost of production that remains relatively constant regardless of the volume of production. Allocation of fixed production overhead is done on normal capacity. So fixed production overhead is defined here, saying that it means that the indirect cost of production which will remain relatively constant even though the production volume increases or decreases. So such allocation of fixed production is done on a normal capacity. Now, a variable production overhead means that the indirect cost of production that varies directly or nearly directly with the volume of production. So basically, fixed, in the case of fixed production, no matter whatever is the volume of production, such costs will not vary. However, in the case of variable production overhead, such costs would directly or nearly directly vary with the volume of production. So this is the differentiation between a variable production overhead and a fixed production overhead. Both of them would be categorized as the indirect cost of production. However, fixed production will remain relatively constant regardless of the volume of production, but variable production will nearly vary or it will directly vary with the volume of the production. And thus allocation of such variable production overhead is done on the actual production as it is as it matters, as there is a considerable change with the volume of production in the costs which are variable production overhead costs. There would be a change in the variable production overhead costs if the volume of production will change. Further, in the case of joint products, when the cost of conversion of each product is not identifiable separately, total cost of conversion is allocated between the products on the rational and consistent basis. Again, this point is very important, and a question can be asked that what happens in the cases of joint products where the cost of conversion is not identifiable separately and thus the cost cannot be segregated between the joint products. So in that case, what happens is the total cost of conversion is further allocated between the products on the rational and consistent basis. So what is the rational and consistent basis? It would be mutually agreed upon that how such joint products or how the cost of conversion of such joint products should be allocated between the products. Further, in the case of byproducts, scrap or waste materials which are not of a material value, they are further measured at net realizable value, and then the net realizable value is further deducted from the cost of conversion. So the costing or the ascertainment of such costs of byproducts, scrap or waste material, even though they are not of material value, however, in accounting standard 2 it has been specifically measured. It has been specifically mentioned that such byproducts, scrap or waste materials would be measured at the net realizable value, and such net realizable values is further deducted from the cost of conversion. And net cost of conversion is then distributed among the main products. And what are the other costs? Till now we have covered the cost of purchase and cost of conversion. Then coming to the other costs that are to be directly attributable to a particular inventory. So cost incurred in bringing inventories to their present location and conditions would be categorized in the category of other costs and items that are to be excluded from the cost of inventory. So till now, so we have done the components of the cost of a particular inventory, which would also include other costs. And now coming to a different topic altogether, which says what will be the items that are excluded when we are valuing the cost of a particular inventory, or when we are valuing the cost of inventories of a particular business. So in that case, what items are to be excluded? All the abnormal amounts of wasted materials, labor or any other production cost should not be a part of the inventories. Further, no storage cost should be included in the cost of inventories. Administration overheads should not be a part of the cost of the inventories. Along with that, selling and distribution should also. So we should be only including in inventories fixed and variable production overheads, and after that we will not be including any administrative overhead or any selling and distribution costs in the cost of the inventories. Again, interest and borrowing costs should also be excluded from the cost of inventories. However, if AS 16 allows such costs to be included, it can then form part. So if it is specifically mentioned and AS 16 is on borrowing cost, so if AS 16 specifically mention and allow such costs to be included, then it can form part of the cost. Otherwise, the borrowing cost or interest cost is also excluded from the cost of inventories. Further, cost formula specific identification method means that such cost is directly linking the cost to the specific item of inventories, which is, I think, a better way of expressing or identifying the cost of a particular inventory. And if in any case specific identification method is not applicable, then the cost of inventories would further be valued by the following methods, and such methods are either first in first out, or we will be ascertaining the cost by weighted average cost. And when it is not practical to calculate the cost, the following methods will be followed in order to ascertain. So either it would be a standard cost method or it would be a retail method, according to which we would be evaluating the cost of a particular inventory. So looking at the definition of net realizable value, so we have up till now seen what are the costs and what are the components that will be included while we are valuing the cost of a particular inventory of the business as according to the accounting standard 2. Now, accounting standard 2 valuation of inventories defines net realizable value as it means the estimated selling price in the ordinary course of business less estimated cost of completion and estimated cost necessary to make the sale. So thus net realizable value means NRV means the estimated selling price that we will have, estimated selling price of a particular inventory minus the estimated cost of completion. It could be cost of completion, or it could be the cost of estimated cost of goods purchased, minus the estimated cost of completion, and further any further costs which are necessary, or cost necessary to make the sale. So this is how we will be determining the NRV of a particular inventory, or of the inventories of the business. It is estimated on the basis of most reliable evidence at the time of valuation. So when we are valuing the inventory at the time of the valuation, on that at that particular time, the most reliable basis would be adopted and thus followed, and on the basis of such methods, we would be estimating the selling price, the estimated cost of completion, and any other cost which is necessary while we would be selling such or making the sale of such inventories. Further, the estimation of net realizable value also will consider the purpose for which the inventory is held. And the estimation is made as at each balance sheet date. So we would be valuing the inventories that are left over in the business at the end of every financial accounting period, which is why we are saying that such estimation of the NRV is made at each balance sheet date, as we will be comparing the cost of the inventories with the net realizable value, and thus finalizing the cost or the valuation of such inventories that are to be shown in the books of accounts at the balance sheet date. And if finished product in which raw material and supplies used is sold at cost, so this is again at the balance sheet date how we will be valuing the particular inventory in the books of accounts. These again would be the important points, that in case the finished good or the finished product in which raw material and supplies which are used while preparing the finished product is sold at cost or above cost. So such finished product in which the raw material and supplies which are used are sold at cost or above cost, then the estimated realizable value of that raw material and supply should be considered more than its cost. Therefore, inventories of raw materials will be thus valued at cost in this particular scenario, where in the case of the finished product, raw material and the supplies that are used at cost or above the cost. So in that case, what will happen is that the inventories of raw material will be valued at cost, right? So this is an important point of AS2, valuation of inventories. And in case the finished product in which raw material and supplies used are sold below the cost, so in that case what will happen is the estimated realizable value of the raw material or supply will be equal to the replacement price of raw material or supply, and this raw material will be valued at replacement point. So these points, although if they are not clear now, I would recommend you to revise the entire accounting standard and then start solving the illustrations. Also, however, also when you will be solving the conceptual part or the questions related to accounting standard 2, you will have a better clarity on what you are reading, as you will then be, after going through the questions or after attempting some questions based on AS2 valuation inventories, a lot would be much clearer when you would be practically applying such valuation concepts to a particular question. Now, what are the disclosures that are required to be stated in the financial statements related to the AS2 valuation of inventories? Firstly, what is the accounting policy that has been adopted while measuring the inventories? Then, what is the cost formula that is used? And further, how the classification of inventories has been done in the books of accounts, and item by item you would also be declaring the value of such inventories. So what are the classifications? Whether there are any raw materials or components of the finished products which will further be converted into the finished products, and as and when it will be converted, it would be valued as a finished product. So for now, the classification would be raw material and components for such final products, work in progress, finished goods, and stock in trade. And such stock in trade which we are referring to is in respect of goods that have been acquired for trading. So along with the goods that are being produced and along with the finished goods or work in progress or raw material and components, we also have certain stock in trade which was procured in order to resale it further and earn revenue from such goods. So that particular good would be regarded as stock in trade. Then again, we will have stores and spares, we will have loose tools and other specific nature items which would be declared and disclosed in the financial statement as the inventories or that are being classified and thus stated in the financial statement. That is, at the end of the financial accounting period, such inventories would be shown in the balance sheet. So with this, we complete the conceptual part of our accounting standard 2, which is based on valuation of inventories. And in the next lecture, we would be solving some of the questions related to accounting standard 2, valuation of inventories, so that whatever we have read so far, on the basis of that, we should be solving the questions related to AS2, which will again help you in understanding the concept with more clarity. So before you start the questions related to AS2, I would say that go first revise the lecture that we have done now and then only start solving the questions. So see you all in the next lecture. Take care and bye-bye.